All right, it's been a minute, Ryan.
Yeah, it's like at least a
Time you
solid
cut,
month.
yeah, last time you cut one of these, it wasn't even Thanksgiving yet,
No.
and now it's Christmas.
Time flies, and
Time flies.
let's see how smooth this goes. Since I'm probably
You a little rusty? You feeling rusty?
Yeah.
Okay. Well, in that case, let's just dig in.
All right.
Hey, everybody, welcome back to the what are we calling this? Casual Friday. Old habits die hard. The Casual Friday Financial Insight Podcast. In fact, I know you listen often, Ryan. We've got a new intro for us to keep up with our name change, and so I hope everybody liked the new intro. If you haven't listened to this before or haven't listened in a while because Mr. Ryan Louie hasn't been on here, my name is Brian Ullman. I'm a financial advisor here at Ford Financial Group. I'm joined by Ryan Louie, also a financial advisor here at Ford Financial Group. If you're watching this for the first time, subscribe to the YouTube channel or hit subscribe on whatever you're listening to, whatever podcast software you're listening to on. I usually use Apple Podcasts. Ryan, you're Overcast guy?
Yeah.
Okay. Well, we're on all of those. Spotify, Google, whatever, podcast, whatever they call it. So
they all work.
Yeah. If you're listening or watching, subscribe. So that way you can catch these in the future with Ryan or whoever our guests are at the time. So it's been a little while. We have some things to talk about. And we've already got a slide on here doing the stock market performance. But before we get into this, I want to ask you, with Christmas around the corner, what's your favorite Christmas movie? You've got an ugly sweater in the background there.
Yeah, I got an ugly sweater back here. As you zoomed in, I noticed that it seemed as if my there's more showing in my office. Yeah, there's an ugly sweater back there for it to be very festive. Yeah. I think I'm just gonna go with what's popular in my household. I actually don't think I really have a favorite, but
you don't have a favorite Christmas movie? Oh, like if you're clicking through and you're like, oh, and
I'm to be honest with you, I'm one of those people that don't watch a lot of movies over again. So maybe that speaks to a little bit of reason why I don't have like a favorite. But so again, household movie, definitely we watch Home Alone like the day after Thanksgiving almost every year for like the last 5 years. And
there we go.
The kids love Home Alone. So I think by default I'll go with Home Alone being household favorite, even though I don't necessarily have one myself.
My kids love Home Alone. I remember watching Home Alone in the movie theater and thought it was hilarious. Yeah. So I like Home Alone. It's not number one for me. Number one, far and away, National Lampoon's Christmas Vacation. Chevy Chase. That movie holds up. I still laugh when I watch that movie. It's great. It is great. It is my favorite. I've probably watched it 3 times between Thanksgiving and today.
Okay.
Popular ones in my house.
Something like Die Hard, what would that say about me?
Yeah, I mean,
you come with those fringe Christmas movies.
I like Die Hard. I like action movies. I like Die Hard movies. I don't think Christmas and think Die Hard. I know some people, that's a popular opinion these days. A Christmas Story is usually a staple in our house. And then I force everybody to watch Peanuts. Watch the Charlie Brown Christmas.
Yeah.
They groan and roll their eyes, but then everybody sits for half hour and watches it, and it's good. It's good. I like that one too. So, okay. Well, let's start with charts. We can start with markets. Jeez Louise. I know it's been a month since we last did one of these, and in November, markets were ripping, but good gravy. As we finish the year, this is a chart that is for today. We're recording this on the 19th. This is current through December 18th, but year to date, the S&P 500 is up 23.5%. We are ripping, and in here shows some of the different, whether it's Brexit, elections, trade wars, COVID, etc. You'll see it's now tagged inflation as our 2022 crisis du jour. But markets are absolutely on fire. Even the NASDAQ, after its closing today, is up more than 53% on the year. And the Russell 2000, which is the small caps, has finally eclipsed the Dow, up 16.5% after being the worst performing index of the whole year. And we're not even into the Santa Claus rally yet. What do you think?
Yeah, look, if you could, I know we can't, but like if you really did just zoom in on the last 2 months, you could see that on the very right side of the chart. It's basically straight
Straight
up.
up. Yep.
Again, a lot of it has to do with the interest rates and what the Fed says.
Yep.
I think it's a little bit, maybe we've talked about this before. Seasonality probably has a bit of an effect to this. This time of year historically does do well, but I think a large part of it that had sparked this was just the language of the Fed, because bonds are up as well. Again, not nearly as much as this, but it is, for most people with a portfolio that has bonds and stocks, you want both sides of the portfolio to go up, and it definitely has done that. November and so far in December.
Yeah, I mean, I don't think there's a coincidence that markets started ripping in November, and November 1st, I think it was November 1st was when the Fed met, or 2nd, came out. And I think it's interesting because they said they weren't raising rates, and frankly, that's what everybody believed. But that touched off this explosion. And as we got in, it's been almost a week now since the Fed met again. And now they're openly talking about cuts versus markets and investors speculating about cuts next year. The Fed's talking about 3 cuts next year. I still think it's 3 cuts because of a recession. But at this point, light recession or economic slowdown, but not a recession, what's the difference? We're kind of splitting hairs where everybody agrees that the economy is going to slow, but interest rates are going to be cut, whether it's the San Francisco Fed member said that she was worried about, we might have to cut because of concerns about over tightening. I mean, they're talking about cutting rates next year. And I think that's the rip right here.
I think you'd almost make the argument that with them talking about it beforehand, cutting interest rates, that it can actually help you avoid a recession in some ways. Because again, this is a large part. You see people see their portfolios go up, especially this time of year.
Yep.
Where people are spending a lot of money anyway.
Sure.
You're more likely to do it when you start seeing your portfolio jump up in value. And so, you kind of see a domino effect of, if the Fed says, okay, we're going to lower interest rates, bond stocks go up, portfolios go up, people are happier, more likely to spend money. The more people spend money, the less likely we're going to have a recession. Yeah,
it's an effective rate cut, like you said. And mortgages, the 30-year average 30-year mortgage is down 1% from its peak. I think right now it's almost exactly at 7, but it even poked below that and had a 6 handle for a little while there. The bond aggregate index was down a little bit more than 4% when it bottomed on October 19th. It's up 5% now. So we got roughly 9% swing in the aggregate bond index. That's like crazy amount of volatility in a good way, I guess, for bonds. It's been a heck of a finish to the year, but it's almost like, we've got 2 weeks left, pretty thin trading the last week of the year. It's going to be curious to see how everybody comes back in January, because if you're calling 2022, we peaked January 2nd, and it was like everybody flipped the calendar from 2021 to 22 and things went straight down. I'm not suggesting that's what's going to happen here, but it's amazing because in real terms, as an investor, there's not a whole lot of difference between December 29th and January 2nd.
Right.
But it's still people trading and investing, and that calendar switch matters to them. So it'll be interesting to see.
I think we saw that too, actually, this last year or this last January, right? We had a huge rally in January. And as they sometimes say too, as January goes, the year goes, and surprised, like it certainly didn't feel like it mid-year, or definitely not towards, the end of summer. Because as we were spiraling down at the end of summer, it didn't feel like we were going to be able to have an up year, as good as January was. But, interesting enough, it kind of played out that way.
Well, you can ladle on all of the historical, if January is good, then the year is good. If January is good after a negative year, the odds are even higher for a positive year at the S&P. Third year of a presidential term, positive more often than not. So, I mean, this was it. We got it. It was touch and go. And I think if you're a non-believer, you kind of got burned. But we did okay. We did more than okay. We did really okay. And we'll see. I mean, 23% is better than anybody had predicted, I think, this year. Speaking of momentum, we can kind of get into the charts if you want. We can start with mine here. I've got a couple just quickly to go over. One is the moving averages. I don't know that many of our clients know what a moving average is. But a moving average is the how would you describe it, Ryan? Like
it's
culmination of the last 50 days, the pricing.
Yeah, well,
of the last
you
50
see a
days,
50, 100, a 200-day moving
Right.
average. It's basically, you compile all those together and take
all the
take
prices
average,
together.
which then smooths. Again, you see the lines, it smooths things out. The higher the amount of days that you have in the average, the less movement you're going to see, the slower it's going to react,
Right.
the smoother the line. And then, of course, as you move it into something like the 50-day average, you see that it tends to move faster because it's going to have the current trading days are going to have more impact on that line or that average than in a 200-day sample.
Yeah, and we've talked before about like there's ripples, waves, and tides, right? And the 50 day is going to be more volatile. It's a smaller sample size, so it's going to move up and down more. 100 days less so. Those will be the waves, and maybe the 200 day could be considered the tides because it's a really big sample size and is moving less. I think importantly here, when these numbers cross over one another, it would tend to tell us kind of market momentum here, right? And so if you're looking at the 50-day average, when it breaks below the 100-day or the 50-day average breaks below the 200-day, you would say momentum is down, and some might argue that would be a sign to get out or get more conservative. I don't think this indicator alone is one that is strictly worth trading on. But you can see it crossed over in the 50-day, crossed over the 200-day in January. It crossed back over the 200-day in January 2022. It crossed below the 200-day. The 50-day crossed below the 200-day. Crossed back over in January 2023, and right now it is finally poking back above the 100-day moving average. And so if you have the 50-day over the 100 and the 100-day over the 200, that tells you things are moving in the right direction, maybe in a sustainable way.
So, yeah, I think visually people probably get a better idea of this. Just look at the lines. You kind of get an idea of when the market's in an uptrend, where the moving averages are heading,
sure,
how they look. And then again, consequentially, you can see it on the how they start to reverse when the market starts to go down. It tends to be definitely when you're talking about indicators and things like that, so much easier to see visually. And again, I get a real good comprehension of like what this means and how you might use it. Again, these are definitely not indicators that you're going to go all in or all out of the market.
No. I think it provides context here where you look and you say, man, the S&P is strung together a few bad days, but then you look at the 50, 100, and 200-day moving averages and you think, and that maybe gives you some context where it's like, oh yeah, these have been a few bad days, but it hasn't reversed the trend. Whereas, a longer period of time, you can look and say, wow, the trend really has reversed. And if you maybe take this in combination with some other things, you could say, oh, this could be reason to be bearish. I can't be a total optimist here because the other chart that I have is the stock market price to earnings ratio. This is the S&P 500 forward PE using earning estimates over the next 12 months. Historical average. So this is when we say markets are cheap or markets are expensive. Usually it's in relation to the historical average, the forward PE or price to earnings ratio for the S&P 500. Historical average is a little bit more than 15.5 times earnings. This is through December 12th. S&P 500 forward PE 18.7, which I believe there's another chart. I think we are more than one standard deviation above the average here. So stocks are doing well, but they're not cheap, especially after the kind of run that we've been on here just very recently.
I think that it gives a little bit of concern when, again, I always say when things are expensive, you kind of know what direction they're going to try to be pulled back. And then at the same time, when they're cheap, you know that they're likely going to get pulled back upwards. I think best case scenario, it's hard. I'm not trying to get into predictions for 2024. That's
we'll do our outlook
that's a fool's
next
game. But
episode.
realistically, as this year was just so odd in regards to like where we're ending up, because it is a very nice return for this year, which then kind of leads me to think that we're probably not going to have back-to-back years of really high returns, especially when you have a PE ratio sitting at that high already. That's kind of my reality check, I think, on where we stand with everything being so expensive already and the returns that we got in 2023.
Well, the momentum is higher, but stocks aren't cheap, and you can look to see, oftentimes they'll revert. Just for some context, that the most expensive they've been is in the last 30 years is 24.5 times earnings. That was in 2000, the tech bubble peak. The low was 9.5 times earnings, but I don't think anybody was looking at 9.5 times forward PE on the S&P 500 and thinking to themselves, yes, this is a buying opportunity, right? This is just like the last slide. This isn't totally instructive. You don't look at this and say, oh, things are expensive. Stuff can be expensive for a long time. Stocks can be expensive for years, and you can miss out on some really decent returns just looking at this and saying, oh, I'm going to wait for, a reversion to the mean, or even below it. So,
yeah, I again, not as an indicator. You couldn't use this. It looks as if the PE ratios were around 22-ish in during the COVID years.
Yeah.
I would not say, if it gets up that high, then I'll consider selling. Like, that's not a realistic game plan for.
Keep in mind that this is also priced forward earnings estimates. So, I'd be interested to go back and during COVID, maybe the earnings estimates were in the can, right? So the forward earnings estimates were really low, but the rate and the prices were higher because rates were slashed and money was being printed. And so that can get that out of whack because there's an element of estimates here. Yes. Right. There's some forecasting going on in this as well. So it can distort the numbers a little bit. But historically, it's pretty straightforward. Stocks are expensive. Stocks are cheap if you pull them.
So you're saying, though, based upon where we are, you are concerned.
I think there's a reason to check your rampant optimism if you've got it.
Yeah.
Right. Things are good. Rates are, the Federal Reserve is even saying rates are coming down. I still think we'll have a mild recession, but even if we don't, economically, we're going to slow down. Prices are going to stop going up. Money's going to loosen a little bit. That's usually good for investors. Maybe we're expensive and we get a little bit of volatility next year because earnings aren't what people are expecting them to be. Right. And if we have
a good point, though, about blind optimism, because you have a year like this. And I'll say that I think a lot of times people, especially with 401ks, they'll look to maybe rebalance their portfolio at the end of the year. But the way they do it is they look at their fund lineup of all their investment options, and they look at the ones that have the highest return, right? Which in this year is going to be stocks.
Sure.
More specifically, it's going to be technology stocks. And then they decide, okay, well, I'm going to go jump on that ship and put more money into that because it did really well in 2023. So hopefully it's going to do that well in 2024. And oftentimes it doesn't end that way.
Wait, are you calling for the Magnificent Seven to come back down to earth?
What?
Are you calling for the Magnificent Seven to come back down to earth?
No. I'm not putting you on the spot. You can't keep piling on to what worked last year is going to work in future years. I
could totally envision a scenario though where, basically for a very long period here, 7 stocks held together the other 497 stocks in the S&P 500. So we get a little bit more breadth here where the rising tide starts to lift all boats, but also AI is propelling things forward, and not just for tech companies, but for making efficiencies for other companies as well. So you get a little bit of that burst, but we get some volatility because stocks are expensive and got to find that equilibrium and maybe come back down to earth if earnings aren't there. And you can throw in geopolitical stuff and a presidential election cycle that I don't think anyone is actually looking forward to unless you're crazy and obsessed with one of the two candidates. And so that could create some volatility. Presidential election year, maybe we don't get some resolution until October. I don't know. I could see a year next year where we have a bumpier ride than we had, or just as bumpy of a ride as we had this year. But results in very solid returns again for the S&P 500 in double digit range, but we'll save outlook. We've got a whole slide deck for outlook. We'll save that for the next one. Okay, let's jump on your chart because we've been talking stocks for a while. Let's talk some bonds.
Yeah. So again, bonds playing an important piece of people's portfolios and definitely have had their volatility for the last almost two years. Really what this slide is saying is, and one thing I don't think people know is that the bonds tend to be a little bit more mathematical in their returns. You cannot say, you can get a very close proximity of an idea what a bond may do if interest rates go up or, 1%, or if interest rates go down 1%. You really can't do the same for the stock market. You can't gauge, the market's going to go down 10% if the market, or if the interest rates go up 1%. It just doesn't work that way, but bonds do. And so what this chart is trying to show is basically the based on duration. So you have, again, these different bonds represented by these bars, these different kinds of bonds, how they react if interest rates go up or down 1%. So, for example, on the left-hand side, you see the U.S. Treasury Index. It will go up about 6%. With the duration, if interest rates move 1%, and so that's in either direction.
Yeah. So let's simplify. If rates go up 1%, Treasuries go down 6%.
Yes.
If the return goes down 6%, right? Because we're talking about treasuries here. We're talking about the treasury returns, right? Or the treasury yield affecting the returns.
Yeah, the yield affecting the returns.
Right. So we were talking about the aggregate index being up 5 or something percent so far in the year, and a 9% swing. So if you look at the second column here, rates on the U.S. Treasury Index goes up 1%. The U.S. Ag will go down 6%. If the price of the U.S. Treasury Index goes down 1%, the U.S. Ag will go up 6%. And that's almost exactly what's gone on in the last.
Yeah. So basically, since November, when you had mentioned, like the 10-year rates went from about 4.9-ish to about, let's call it 3.9-ish. So fell about 1%, the yield. And the bonds went up about 7% during that time. So it's about in line with what you're seeing on this chart. And, we are now heading in that direction. The momentum for yields is to continue to go down because we expect that the Fed's going to lower interest rates, right? So we kind of know if they continue to go downwards, you're going to get some upside potential in appreciation from your bonds.
Right.
Now, again, hopefully, let's say that the yields drop another percent, you may get a 6% appreciation in your bonds, which again is good when you add that on plus the interest that they're paying.
Yeah, I mean, and think about this. If we're talking about, if treasuries drop 2% next year, let's say, because we're in a recession, rates are being cut, we're talking about double-digit returns out of the ag, right?
Right.
It reminds me of what happened coming out of the great financial crisis or great recession, whatever we're calling it now. Bonds were ripping and giving equity-like returns with a fraction of the risk as rates, and as we kind of everybody was digging out of it and rates were bargain basement. It's easy to look at a portfolio, if you're watching this, you're looking at your portfolio of the last year or two and look and say, God, bonds, why do we even bother with bonds? What are we even doing here? We're coming out of the worst stretch for bonds that we've had in history. This would be the equivalent of selling low if you're in a conservative portfolio and bailing on your bonds to go to a money market fund or something like that. If you're managing your portfolio looking in the rearview mirror, bonds don't look great. But if you're looking out the windshield, now's the time to keep those in your portfolio, right?
Yeah, we haven't had this kind of setup for quite a while where the bonds have that potential to go up because interest rates have just been historically low for such a long time. There was no potential for the bonds to really have that kind of appreciation. And now we actually have that in front of us. So definitely a time where we can see some decent returns from them. They give more protection in this current environment, right? If we do hit a recession, because they have the potential to appreciate. If we were sitting here at 1%, Fed funds rates, there's just not a lot you're probably going to expect that your bonds are going to appreciate, because
you just clip the coupon. That's it.
Yep. And so we are in very good situation. Again, that we have not been in for a very, very long time in the bond market.
There you go.
Now, I will also say this: the expectation too should not be for people to expect that we're going to get back to the lows of the interest rates that we were once in.
No.
That would be the furthest thing from one of my guesstimates of what's going to happen in the future. I think somewhere between the highs of where we've seen these interest rates already and probably the lows is, maybe that's something at least reasonable, but we're not going back to a couple years ago with 0% interest rates.
Not at all. Not at all. No. And I don't think anybody's carrying those expectations. The 3% days of 3% mortgages. And I mean, if we're back there, something's gone really poorly.
Yes. Right. I mean, it would signal that we need to stimulate the heck out of the economy, because the economy's on life support.
Yeah, you could read the tea leaves on this one and be like, that we're talking massive recession. Yeah. If rates go back to zero and we're stimulating the economy, that's right. I think the Fed hated being in the position they were in with being beholden to markets and 0% interest rates before COVID. They've been able to use this pandemic, and I don't mean this like conspiracy theory, aluminum hat wearing kind of stuff, but they've been given an opportunity to normalize rates, and they've taken it. And I think they're going to keep rates, within reason, as normalized as they can, and keep that ammunition. They'd rather, if we're in a recession, they'd rather cut rates from 5 to 3 instead of 3 to 0.
Yeah. It's having continue to have tools for them to use.
Yep. Okay, stocks, bonds on a tear into the end of the year. We have Santa Claus rally, I think, is technically like the last week of the year. I don't remember exactly what the days are. So this isn't even Santa Claus rally yet. So hold on. We're not done yet. We could be higher both for stocks and bonds. All right. So Ryan, tell me, as we head into the year, I'm not going to ask you what your New Year's resolution is. I'm going to do that next time.
Okay. I'll have to prepare something.
You still have a week and a half to think about that. But what's on your mind today?
So just with going with the kind of the holiday spirit, or maybe this sounds like it, maybe it's not the holiday spirit. We ended up getting, a fake Christmas tree. And so we've had it for a few weeks. And again, I grew up going to the Christmas tree farm with my dad, picking out a tree. So we've always had one. I carried that on, and we carried on having a real tree even with my family now. But we ended up getting them from Costco the day after on Black Friday. You didn't even know what you were getting, because they were all like wrapped up, and they basically give you a tree, and you got to hope for the best. So it's a surprise when you open it at home. But I will say, like, it's nice having an artificial tree. There's the ease of it. I will say, as you get older, like, you kind of push the responsibility of having the kids like water the tree. And I'm going to say the last several years, they
a dead tree
that great of a job. And then we have, we have a Christmas Eve party, and, we have, I don't know, 25, 30 people come, and, my wife's always complaining, oh, but the tree looks dead. It's all sagging. And so, I don't have to worry about that. It's just, it's been pleasant.
Yeah. This is our last year for a real tree. We've had a real tree for the last few years. I really didn't want to store a fake tree for a while, but
that's got to be the biggest downside to having one.
Yeah. But the reality is, we had the lights on the top third of the tree go out. So we have like a 2/3 lit tree right now, and it's a pain trying to figure it out. We're going to have to untangle this and rewire it, because we have everybody coming over for Christmas also. So it's not just not watering, but having it pre-lit is a nice luxury. Yeah, if you can swing it. We're probably
the pre-lit. I don't know what I was expecting with it, but really, you don't even plug in the strand to the next strand. It is literally in the base. So once you connect the one base to the next, the lights are now connected, and you connect it into the next base, and those lights are connected. It was simple as can be.
Yeah. We had one at our last place that we used for years. I did the math. Now they've gotten more expensive, but here we'll keep this a financial podcast. I did the math, and the break even was $3.5 uses. So by the time you got to year 4, you were in the money compared to a real tree at the time. But now tree inflation is real. Now I know fake trees are more expensive also, but I'll bet you the break even on a fake tree is if you do use it 3 or 4 times, still you're in the money compared to if you were getting a real tree year over year over year.
Now that you're telling me that, it makes me feel bad that it took me this long to do it.
Oh, see, price per use. This is your mantra. This is
right.
This is what I've beaten in my family as well. All right. So I've got something different, not Christmas related, on my mind. Spotify. Spotify is what's on my mind for a couple of reasons. But first and foremost, they have rolled out a feature where included in your subscription are audiobooks. I'm not a big audiobook guy. I don't like paying for audiobooks. I listen to them. I fall asleep listening to them. I prefer to read. That's just how I work. But all of the titles that you consider buying or listening to, I also only listen to audiobooks if the author is reading them.
Okay. Which is what percentage?
I don't know. But like Trevor Noah's book or Tom Segura's book, like comedians do their own book. Tina Fey did her own book. I'm listening to another one that's on some other stuff. They did their own book. It's great though. Like suddenly there's so much more value in a Spotify subscription than there was not that long ago. And I feel like right now with subscriptions, they're getting more expensive, but you're not getting more value. You're not getting more content. You're not getting better content. You know, Netflix is what Netflix is, and they're just raising their prices. But Spotify has actually delivered something that makes it better than the way it was before.
So if you end up listening to more books, does that mean that you're going to read less, or you're going to read the same amount and just listen to more books? And then you listen to more books, does that mean you listen to less podcasts?
It may mean I'm listening to fewer podcasts. It basically adds another choice of what I'm in the mood for. There are books that I bought that I haven't read yet that are available now for free on Spotify. So it may have prevented me from buying them. Like the Rick Rubin book on creativity, right? That's in my bullpen ready to go. And then what do you know? It's available to listen to, narrated by him for free on Spotify. That probably would have cut me from buying it. But either way, I mean, it goes from, Spotify is kind of a cool deal to, wow, audiobooks make it more valuable. So that's what's on my mind. I think it's on my mind because I'm still waiting on that car, but there's Spotify built in and there's no CarPlay on the Rivian. So
there's no CarPlay?
Nope. Just like a Tesla, no CarPlay.
So they'd use their own version of it.
So built into Spotify and TuneIn and some other stuff. But I listen to all my podcasts, kind of like what we started with. I listen to all my podcasts on Apple Podcasts. Mm-hmm. So if I want it to the car, I might have to switch to my podcast listening to Spotify, which I'm not exactly excited about. But the audiobook things make me much happier to have Spotify at my fingertips in the car.
Well, like you said, at least at the end of the day, you're getting more value for what you pay for.
Totally.
As long as you use it.
As long as you use it. Yeah. And I have been, and it's a nice perk. So there you go. That's what's on my mind. Audiobooks on Spotify. I think it's great. All right. We're going to leave it there. Merry Christmas.
Yeah, you too.
Well,
glad to be back.
Happy New Year. We might do one of these in between. Never know.
Yeah, we got a week. We got another week.
And if we
I
don't,
if we don't get back to it next week, we'll be at it the very beginning of January. We got to have some kind of recap of the year and some prognostication about 2024.
We'll go over the LPL outlook together. Talk about our New Year's resolutions and our schedule. Our recording schedule for 2024 is every other week instead of twice a month. It seems like a minor change, but it's actually impactful.
Yeah.
Steadier. So, all right. Well, if you haven't subscribed, now's the time. Hit the like button or hit the subscribe button. Hit the subscribe button on your audio podcast if you haven't done that already. info@fordfg.com is our email address. So if you are watching this or listening to this and you have a question that you'd like us to address, we will, within our capability, without giving specific recommendations, you can email us at info@fordfg.com. So with that, Ryan, another year in the books, on to 2024.
Yes.
All right.
Merry Christmas, everyone. Happy holidays.